Welcome to the PFP podcast from the Personal Finance Society, a place for thought-provoking discussion from the world of financial planning and beyond, giving PFS members and the wider profession an insight into key developments across the sector and the work of the PFS, the professional body dedicated to building public trust in the financial planning profession. I'm Ariane Shepherd, PR Executive at the Personal Finance Society. In today's podcast, we're looking back at the autumn and spring statements focusing on inheritance tax and pensions changes that financial planners and their clients need to be aware of. We are joined by Toyin Oyeneyin, Tax Product Specialist at Octopus Investments, and Dr Matt Connell, Director of Policy and Public Affairs at the PFS. Here is my conversation with Toyin and Matt. Hello to you both, and thanks for joining me on the podcast today.
Hi.
Hi.
Nice to have you here. So to begin with, Matt, could you please provide a brief overview of what was announced in the autumn and spring statements that could impact financial planners and their clients?
Yes, absolutely. So up until now, pensions have been a fantastic vehicle for inheritance tax planning because the pension exists outside of an individual's estate. So any money left to children that would maybe qualify for inheritance tax if it was in a mutual fund or another investment. If it's in a pension, because it's outside the estate, it enjoys a privileged position. And even before the autumn budget, there were commentators who were saying, well, this looks too good to be true. The benefits that people are getting from being able to avoid inheritance tax by putting money into a pension, on top of all the other benefits that people get from saving into a pension, including tax-free cash. This is just too generous. So respectable organisations like the Institute for Fiscal Studies were calling into question whether pensions should be outside of inheritance tax. And I think the IFS had a proposal that 80% of a pension fund should be liable for inheritance tax. The reason they said 80% is because of interactions with income tax. So in the autumn statement, the Chancellor did move to take away inheritance tax from pensions. So under the new rules from the 6th of April 2027, most pension funds will fall into the estate for IHT purposes. There are a couple of exclusions from this. So there are some situations where money in a pension fund is excluded because it has no capital value or can't be commuted for a lump sum to pay an inheritance tax charge. And this includes incomes paid to beneficiaries from pension schemes, usually provided from a defined benefit pension scheme. And it also includes ongoing related annuity payments on the death of a annuitant. The final one as well is charity lump sum death benefits. That's exempted because it's a payment to a charity where there's no dependent. So there's a few exceptions in there, but most other payments are expected to be included. There's a few transitional arrangements to be worked through, but that's the situation we're in at the moment.
Okay, that's great. Thanks, Matt. And Toyin, what is your take on the tax changes announced by the UK government and the impact these changes will have on pensions and inheritance tax?
Pensions were probably one of the biggest changes in the budget, but it was included with a raft of other changes that are going to impact advisors and the general public from a tax perspective. So the context to advisors is there's a lot going on, essentially, not just pensions, but pensions is probably the biggest thing that they're focusing on. So to jump onto your question, the impact of this is significant, really. So as Matt's mentioned, it's bringing it back into the estate for IHT from April 27. So the reason why this is actually quite significant is because many people have been using pensions as a way of passing on wealth free from IHT. That's what they've been using it for a very long time. So the government is essentially trying to recalibrate that. And they actually did say that the intention for pensions isn't to pass wealth free from IHT. It was for using it in retirement for living, essentially. So they're trying to recalibrate that. So I think that's the biggest change, really, changing how individuals and also planning happens for IHT perspective. But if you want to go into a bit more into the detail as well of what this means, it has wider ramifications, right? It means a lot more people are being dragged into the IHT net that probably wouldn't have been previously. It changes things in terms of certain allowances that can even be available. So going on to, let's focusing on the residence nil rate band for a point, which is essentially an allowance if you have a home in your estate and you pass it to your beneficiaries. That allowance can be tapered down if your estate is more than 2 million. Now, with pensions being brought back into the estate for IHT, it's expected that that value of the pension pot will be included in your estate for this test for the residence nil rate band. So you have this almost double whammy of having IHT on pensions, but plus also potentially losing allowances or reliefs essentially on it. So those are probably the biggest impacts really of changing how people think about estate planning. A number of more people are going to be brought into the IHT net. It impacts various allowances. And essentially, I think as Matt mentioned, almost all pensions will be brought in now. So the real impact is there were slight differences between those having defined contributions versus defined benefit pensions. Essentially, almost all pensions will be brought in, apart from a very select list that Matt just mentioned. But there are some benefits still. Planning such as passing to spouses can still work. It's still exempt from a pensions and IHT perspective. So if you passed on your pension to your spouse, the rules do not impact that. So that's still beneficial in that sense. But the change is significant.
Okay, thanks, Toyin. That's great. Really insightful. And Matt, would you say that these changes will have a particular impact on certain groups? So, for instance, are individuals who are thinking about retirement more affected by these changes to IHT, or are there particular concerns for higher earners?
Yeah, so obviously the number of people who have any inheritance left over, as Toyin said, this doesn't affect people passing money to their spouses. So this is going to affect people who have a big enough pension that even if they die first and pass money to their spouse, or if they die later and pass money directly to their children, they're going to be affected. So, when you think about things like the cost of long-term care, all the costs that people face in retirement, there aren't going to be a huge number of people who are going to be affected by this change. It's probably in the low single digits of a percentage of the population. But I think the biggest effect will probably be people who are quite a long way into retirement, who have maybe thought about inheritance tax, taken advice about inheritance tax, and decided that putting money into the pension is the best way forward. And obviously, those people are in a difficult situation because they can't sort of rewind 3 or 4 years and give money away, say, to their children, which is maybe the route that they would have taken if they'd known that this loophole was going to be closed off. So they're the ones who are most effective. People have started doing their inheritance tax planning a few years ago, who perhaps would have done something different a few years ago, but they can't rewind to that point. They've got to go forward from here. And some of the ways of managing inheritance tax, like giving gifts, that strategy only comes to full fruition after 7 years or so. And so that's a situation that people find themselves in now, where they felt like they had a good plan. They've been following that plan for a few years, and now they've got to completely rethink it.
Okay. And why would you say the UK government has taken this action? And is there a possibility of any U-turn in these decisions, in your opinion?
I guess we all know that UK government is under a lot of pressure financially. Every week we hear of a new issue that the government's got to take on, whether it's in foreign policy or trade policy, or, kind of just heard about British Steel. So the bills are mounting up for this government. We've already got a government that's in quite a lot of debt by historical standards, for all sorts of historical reasons, and so it is a government that's looking to raise revenue everywhere they can. And again, given the anomalies that Toyin has talked about, this was an obvious target. But there are still sort of transitional issues to be ironed out. So, for example, people over the age of 75, that's a double taxation issue that could give people very, very sizable tax bills on money that they wouldn't be paying that level of tax necessarily if they'd inherited the money in a different way. So that's one element that I think we'd expect the government to look at through the transition phase.
Okay, great. Thanks, Matt. And Toyin, would you say that pensions can still be used effectively for estate planning?
The answer to that is, from an IHT perspective, after April 27, no. So just going back to the point, essentially, the government's trying to recalibrate that. They're focusing on individuals using it during their life rather than passing it on free from IHT. From income tax perspective, which is what Matt is just touching on, the rules as it currently stands is if you were to pass away under 75, the drawdown from the pension by your beneficiary should be free from income tax. Whereas if you were to pass away after 75, the drawdown from the pension from your beneficiary should be subject to income tax at their marginal rate. So from an income tax perspective, there's no indication of those rules changing. So can it be effective from that perspective? Potentially, if you pass under 75. As Matt mentioned, there's a lot of people lobbying to the government about potential changes. Will they consider this? The effective tax rate can be very high when you're considering both IHT on the pension plus this marginal rate of income tax if you die after 75. But at the moment, the government is very much almost digging their heels in, essentially saying that they are not wanting to change anything at the moment. So, but we will see. But does it really mean that pensions are still going to be effective? Well, like I mentioned, from IHT, not really. From a broader perspective of passing on wealth, well, you're still passing on wealth. It just means the tax efficiency of it is lost effectively. And so where there is lack of tax efficiency when you're doing estate planning, any estate planning, you're essentially removing an amount that would pass to a beneficiary, which is why tax planning or IHT planning and estate planning go hand in hand, because any amount that goes to tax is not going to your beneficiary. So really for pensions in the estate planning world after April 26, for its effectiveness in estate planning, it's not going to be as effective. So which is why almost every advisor I've spoken to after the budget, the conversation starts with, well, I had a plan for my clients, but pensions, and it changes everything. They're saying they're having to start again, effectively. They're having to go back to the drawing board and looking at all estate planning options to start again because it's changed it all. So really, part of the reason in this is for estate planning, pensions used to be, and Matt could comment on this as well, touched last. Advisors would always recommend to their clients to basically, when you're in retirement, use everything else first and touch your pension last. And that was also because pensions were going to be free from IHT. Now that's no longer the case. So now people are recalibrating that, saying basically, maybe if you have the excess funds to perhaps access your pensions now if you were using pensions for IHT planning, because from an estate planning perspective, it's not really going to be that effective post-April 27.
Okay, so does this change how people are thinking about contributing to their pensions, or are other vehicles more appealing now?
Definitely. So how sometimes advisors consider clients are accumulation phases and decumulation phases. So accumulation phase is where you are kind of building wealth. So that's your, let's say, 30s, 40s, 50s, and 60s, and so on. And then decumulation is where you're essentially looking at where you're either retired and then you're using up the wealth that you've built. So you're actually accessing that decumulation. So we've talked a lot about those, and Matt mentioned this as well, those who are in the decumulation phase, right? They were using pensions perhaps for IHT planning, and now they need to consider how they essentially recalibrate that for other planning for IHT. That also is relevant for those in the accumulation stage. So previously, those who might be putting lots into their pensions with the view that in the future, when they retire, will also pass free from IHT. Now those in those accumulation stages, so maybe a bit younger, are understanding that that might not be the case. So they're now looking at potentially other vehicles to put their funds into, as well as pensions. Pensions are still a good income tax and retirement planning vehicle, but they're now considering in their accumulation stage where they're building wealth, perhaps diversifying the vehicles that they put their funds into, not putting everything into the pension. So we're seeing that a lot, actually. So particularly for those in the accumulation stage. And there are different vehicles. There's a variety of vehicles for that. There's, of course, ISAs, which we know the government's also looking at the moment as well. But there's things like VCTs, which we've always said is complementary to pensions in the sense of they have an income tax relief. They're also free from capital gains, free growth. But actually, similar to pensions post-April 27, they'll actually be subject to IHT. But there's lots of different planning. There's business relief, and these are more specialist investments, but they're broader type of investments you can do, as well as broader estate planning you can do as well. So yeah, to your question, hopefully answered, is yes, those also in the accumulation phase are thinking differently about how they're going to contribute to pensions and perhaps diversifying it a bit.
Okay, that's great. Thank you. And how are conversations about passing on wealth to children and grandchildren shifting as a result of the changes to IHT rules?
That's a good question. There's a level of urgency now. I think the budget, it sometimes helps when there's a clock, right, ticking. So we know, for example, for pensions, it's April 27. So, that's the day it's going to change. So there's a level of urgency now, I think, in conversations about passing on wealth and doing so efficiently, which perhaps has always been around, but there's a more of a drive to that as a result specifically about the budget. So what we've been speaking with advisors on is clients are actually not just the advisor approaching the clients are approaching advisors to also have these conversations a bit earlier. So they're also aware, they can see everything that's going on in the press of what is going on. So they're seeking advice from their advisor. So conversations are starting earlier. It's really important, which is very clear now, to start engaging with the generations earlier as well. So from an advisor's perspective, when a client passes away, it's a much more difficult conversation to engage with children, grandchildren once the client's passed away, because you've not built that relationship yet. So what we're seeing is that's trying to change now. So advisors are trying to, while they're having conversations with their clients about estate planning, a big focus is on bringing in the children and grandchildren in the conversation. Who are the people who are set to inherit? And there's a stat that's been banding around for a while from King's Court Trust is there's about 5.5 trillion in wealth that's to pass through the generations, essentially in the next 30 years. So that's significant, right? And then if you're thinking about these IHT changes, particularly on pensions, that is a huge amount that could be taken away from that wealth that's passing away. So speaking to generations, younger generations earlier, who are your clients' children, grandchildren, is really important. Having tools in place to understand how they engage differently is very important. As we know, generations are quite different. Those, as they say, in let's say Gen Z and so on, are very much on the tech aspects of how they engage. It'd rather probably emails or texts, whereas those who are, let's say, more seasoned, I wouldn't say older, I would say seasoned, will more want face-to-face or a call. So really understanding how the different generations want to engage with you as a financial advisor is really important. And that's what we're seeing is changing now. Advisors are very much more aware of this. They're aware of how they need to change either the way they operate to ensure that they're undertaking and delivering a full-scale intergenerational planning for their clients, both from the clients through to their children and grandchildren.
Yeah, that was great. Thank you very much, Toyin. Matt, if I can ask you, it has recently been reported that 9 in 10 financial planners are turning to specialist IHT support. Why do you think this is the case?
Well, it's just the sheer complexity of the situation, and I think that the size of the changes, and as you heard from Toyin, there's not one simple response to this situation. There's probably more than half a dozen different strategies that people could take in the light of these changes. And again, the changes are subject to consultation, so there might be further nuances and refinements. I think increasingly the core expertise of an advisor is helping people to understand what their objectives are, to understand how their financial objectives fit into the relationships that they have in their lives and to the rest of their lives. And so the advisor's skill is really to make finances come alive, to make it relevant to people, to be able to structure and manage conversations around that. I think the more technical elements, increasingly as they become more and more complicated, are often best dealt with by a specialist. And, we work with different professional bodies around Europe, for example, and in countries like Italy and Spain, a financial advisor would never go near tax planning. That's just not something that they do. That you leave that to an accountant. So I guess there's so many different facets to giving successful financial advice. I don't think it's a huge surprise that it's now much more of a team effort to produce the very best financial advice than something that's left to one individual purely on their own.
Great, thank you. And if I could ask you both for your advice on what support there is out there for advisors.
There's a lot of information out there. There's a lot of support. I can also talk from an Octopus perspective, if that's helpful. So there is so much that we want to provide for advisors, because we know, as Matt said, there's so much technical points also to estate planning. There's an emotional side to it, which advisors are fantastic at, and advisors are very technical as well. But there's so much detail, and particularly around these changes, that we understand support's needed. So we have a variety of things. We have an intergenerational planning team. So essentially they can support advisors and their clients when they pass away, but they also work with advisors. Like we mentioned, it's really important to engage with the generations before a client passes away. So they also support advisors in that. We have an Ask Octopus help desk, which is a new estate planning help desk for IHT and estate planning queries. It's free, and we give support and guidance to advisors on any queries they have on client cases. We have Octopus Legacy, which provides almost like a holistic support in estate planning services, wills, lasting power of attorneys, trusts. It could go on. Essentially, they're trying to help advisors provide value or added value to their clients by helping them free up their time, essentially, knowing that some things are quite specialist and they need kind of support in that area. And then, of course, we have lots of webinars, content, thought leadership, and practical support. So I could go on, but I don't want to be too Octopus biased. But there is a lot of support out there for advisors, particularly around the UK, but also from an Octopus perspective, for sure.
Great. Thanks, Toyin.
Absolutely. That's brilliant. And I guess from the PFS side, there's also technical information on the PFS website. There's one article in particular called Pensions to be Hit by IHT Charge, and that contains details about the change, and also a sort of checklist of actions that advisors can be taking with their clients on the back of these changes.
That's great. Thank you very much, Matt. And finally, do either of you have any final thoughts or advice for listeners, both who are financial advisors or just for the public?
For the public, I would say engage with a financial advisor. We're seeing many stats in the press of the level of people who haven't engaged with a financial advisor. So they are there to support you and guide you in times that are good and times that are difficult. So definitely for the public, engage with a financial advisor. For financial advisors, we understand your time is limited. There's lots of changes, right? It's not just tax changes, regulatory changes, the economic volatility. But I think the key thing we would want to say is, our final thoughts is, you're not alone, essentially. Think creatively, use all the support that's available to you. And there is a lot out there, like we've mentioned. And again, from an Octopus perspective, we very much essentially are here to support advisors. That's kind of what we do.
Absolutely. So absolutely, for the public, chime with that sentiment. There's so many elements where people can benefit enormously from financial advice. And again, not just from tax planning, from just having clear objectives and following those objectives. And I think the overall advice, going back to what Toyin said earlier, this doesn't change the ability of people to transfer wealth, the fundamental ability for people to transfer wealth. It's just one strategy has been closed off, but there are other strategies. And so there are lots of ways for people still to fulfill their financial goals. It might just be in a slightly different way and at a slightly different tax rate. And that's just how it is with how the world changes. So this isn't the end of the world. People shouldn't be abandoning the idea of financial planning. If anything, this reminds us of how important it is to have a plan and keep it updated.
So I totally agree with Matt's comment that the changes with pensions is a change, but there is so much estate planning options out there as well. As we know, there's a variety of options to choose. Of course, business relief is something that has come to a bit more of the forefront, like even in the government's policy paper on pension changes, they actually note that they expect an increase in the use of business relief and agricultural relief planning as part of estate planning. So they're aware of this. But even business relief is just one option out of a variety of options of estate planning. So consider all that's available to you and your clients that can deliver good outcomes for your clients.
Okay, great. Thank you, guys. You shared some really insightful points, and I'm sure everyone listening has found that really helpful. So thank you both very much for joining me on the podcast today.
Thank you.
Thank you.
Thank you for listening to this episode of the PFP podcast. You can find useful links in the show notes and related articles on the Personal Finance Professional website, along with further podcasts. Please like, review, and subscribe. Until next time, goodbye.